You're speaking to your bank or your financial advisor about a commercial mortgage to buy your premises, and they turn around to you and say, well, the maximum we can do is 70% loan to value. Well, what exactly do they mean? I'm sure you'll agree that many industries have terms and phrases which mean a lot to the individuals within that industry, but not a lot to people outside of it. And loan to value, or LTV, is one of those phrases. So in what context would you have heard this? Well, if you're looking to buy a business premises, you'll need a commercial mortgage. And quite likely the conversation you would have had with the bank is, I'd like to borrow some money, please. The bank turns around and said, sure, we'll lend you a maximum of 65% loan to value. Well, that means that if you're buying a premises worth £1 million, for example, and the bank is lending at 65%, means they will lend you £650,000, meaning you've got to bridge the gap to the tune of £350,000. That's loan to value. It's the amount of the loan divided by the valuation times 100. Now, why does the bank limit its loan to value? Well, there are two reasons. Number one, your contribution. By maximising their exposure at, say, 65%, the bank is forcing you to fill in the remaining 35%, or £350,000. It means that you have some skin in the game. The bank is not taking all of the risk. And from the bank's point of view, why should they do all of the risk? They want to make sure that you've got something to lose as well. That's where the loan to value comes in, forcing you to put money into the project. The second reason is, well, the bank wants to give themselves some wiggle room in case things go wrong. So, for example, if the bank had lent you the full 100% of the purchase price and your business failed 12 months later, what are the chances of the bank actually selling it at the £1 million that you bought it for 12 months before? Probably pretty slim. So the bank wants some headroom just in case they do have to force you out, repossess the property. They want to make sure they've got enough headroom to allow for fall in prices and also the costs that go with selling the property as well. It just gives them headroom. Now, and a little nuance on this as well, you may have the bank say to you that, well, we're only going to lend you 65% on a 90-day value. What is that? Well, that is a figure where if the bank had to dispose of the property within 90 days, i.e. 3 months, a very quick sale, I think you'll agree that that means that the valuation would come down a lot because it is a distressed sale. And that gives the bank even more comfort. You typically find those kind of 90-day and 180-day valuations where bridging loans are concerned, where the bank is taking a very high-risk punt over a short period of time. So there we are, loan to value. That's why it's important. It forces you to make a contribution and it gives the bank some headroom in case the deal goes wrong.